Let me start with something every trader needs to hear. You will never outsmart uncertainty. You can measure it, study it, even predict it occasionally, but you can never escape it. The market's job is to express endless possibilities. Your job is to define your risk inside those possibilities. That's where the stop loss comes in. It's not a mechanical tool. It's a mirror of how much uncertainty you're emotionally capable of accepting before your mind begins to sabotage you. Most traders think of a stop loss as a defense mechanism, a fence built to protect their money from the market. But in reality, the stop loss protects your clarity. When you trade without one, you leave yourself open to psychological chaos, the need to be right, the hope that the market will turn, the fear of realizing a loss. Each moment you delay closing a losing position, your emotional capital bleeds faster than your financial one. The real danger isn't the loss itself. The danger is what the loss represents to your ego. Without a predefined stop, every tick against you becomes personal. You start interpreting market movement as a reflection of your worth instead of your plan. You stop analyzing and start rationalizing. You go from being a strategist to being a spectator of your own destruction. A stop loss, when used correctly, ends that emotional spiral. It transforms uncertainty from something threatening into something measurable. It defines where your hypothesis is no longer valid, not where you can't take it anymore. The difference between those two is what separates traders who survive from those who burn out. The correct placement of a stop loss begins with acceptance. Acceptance that every trade has the potential to fail. The trader who can accept that truth before they click buy or sell is free. Because freedom in the market doesn't come from profits, it comes from detachment. When you place your stop, you are not predicting failure, you are defining your freedom to participate without fear. Think about this. Every stop you set is an agreement between your logic and your emotions. Logic says, this is where the market will prove me wrong. Emotion says, I don't want to admit it. The trader who allows logic to win consistently gains access to a mental state of neutrality, the state where opportunities can be seen clearly without the fog of regret or hope. Placing stops correctly has nothing to do with indicators or secret formulas. It's about alignment between your belief in randomness and your respect for discipline. You place your stop not where it feels safe, but where your trade idea becomes invalidated. Anything else is a fantasy, a hope that the market will bend to your emotional threshold instead of your strategic logic. Traders often move their stops farther away, giving the market more room to breathe. But what they're really doing is giving their emotions more room to rationalize. They are feeding the illusion that control over the outcome is possible if they just hold on longer. In truth, every move stop is a confession that you've stopped following your rules and started negotiating with the market. There's a kind of calm that comes when you finally stop trying to avoid pain and start managing it. A well-placed stop loss allows that calm to exist. It frees your energy to focus on execution instead of damage control. It creates a rhythm between taking risk and releasing it, like breathing in and out. That rhythm is what consistency feels like. Here's the paradox most traders never realize. The stop loss doesn't stop you from losing. It stops you from destroying yourself while losing. It allows you to lose small, so you can stay in the game long enough to win big. The trader who refuses to use it is like a pilot flying without instruments, trusting their feelings instead of their gauges. It might work for a while, but eventually, the fog always comes. In every trade, there's a moment when you must decide whether you're trading your plan or your fear. The stop loss is the physical expression of that decision. If it's placed correctly, it's not an escape hatch. It's a commitment to your edge. It says, I will not give the market the power to define my emotions. I define them by my own rules. Every successful trader eventually learns that survival is more important than perfection. The stop loss embodies that philosophy. It keeps you in business when others are blown out. It's the invisible shield that protects not just your capital, but your confidence, your focus, and your long-term growth. When you learn to love your stop loss, not fear it, not resent it, you finally step into the mindset of a professional, because a professional knows that the market's randomness is not the enemy. The only real enemy is your refusal to respect it. A stop loss is often misunderstood. Most traders see it as a technical mechanism, a simple tool that closes a losing trade before it becomes catastrophic. But in truth, a stop loss has very little to do with price and everything to do with psychology. It is not just a financial tool. It is a psychological boundary, a line drawn in the sand that defines the limits of your emotional endurance. The stop loss doesn't protect your money. It protects your mind, because once your mind is gone, your capital follows. Every trader believes they can handle risk until the market tests them. It's easy to promise discipline when you're calm and detached, when the chart looks clean and the candle has not yet moved against you. But when the market turns and starts pressing on your open position, your brain shifts from logic to survival. The calm, rational analyst who placed the trade transforms into a fearful participant caught in a storm of emotions. Doubt, hope, regret, denial. That's when the stop loss reveals its true purpose. It's not there to save you from losing money. It's there to save you from yourself. You see, the stop loss represents acceptance. It's the trader's acknowledgement that they are not bigger than the market. It's the surrender of the illusion of control. The market doesn't care about your analysis, your strategy, or your conviction. It moves according to the collective psychology of millions of participants, each driven by their own beliefs and emotions. In that chaotic environment, the stop loss becomes the only constant, the one rule that anchors your behavior amid the storm of randomness. It defines how much of your mental peace you're willing to sacrifice before you let go. Most traders place stops to protect their money, but professionals place them to protect their mindset, because your mindset determines everything that happens after the trade. If your emotions take over, you might widen your stop just a little, telling yourself the market will turn. You might remove it altogether because the thought of realizing a loss feels unbearable. And then as the market continues to move against you, what was once a manageable drawdown turns into paralysis. You stop reacting, you freeze, you stop following your plan, you start negotiating with uncertainty as if the market could be reasoned with. That's the moment the market takes everything, from your confidence to your capital, because you failed to respect the psychological purpose of your stop. The stop loss is not a fence built against losing trades. It's a reflection of your willingness to experience uncertainty with grace. Every trade you take is a hypothesis, not a guarantee. When you place a stop, you're saying, if this idea doesn't work, I'm fine with that. That's mental strength. The stop is not a punishment, it's a form of liberation. It releases you from the emotional attachment to a single outcome. It allows you to move on quickly, to reset your state of mind, to approach the next opportunity with a clear head instead of emotional residue from the last one. Think about it. If you place a stop at a certain level, it's not because you know the market will reverse there, it's because you've decided that beyond that point, the probabilities no longer favor your trade idea. It's a rational decision rooted in your methodology, not your emotions. The stop defines where your belief becomes invalidated. Anything beyond that is no longer part of your strategy. It's part of your ego. And trading from ego is the fastest path to self-destruction. A trader without a stop is not brave. They are in denial. They are refusing to face the uncertainty that defines the market. They want control where none exists. They want certainty in an environment built on probability. But markets don't reward stubbornness. They reward neutrality. The moment you place a stop, you accept that you might be wrong. You make peace with that possibility. That peace allows you to stay mentally balanced when the market moves against you. Without it, every tick becomes a personal attack, every loss becomes a blow to your identity. When you look at the world's best traders, you'll notice something interesting. They don't attach emotional meaning to individual trades. They see every trade as one of 1,000 in a long statistical series. They understand that losses are not failures. They are part of the equation that makes consistency possible. That mindset is only sustainable because they use stop losses effectively. A stop allows them to execute a strategy repeatedly. Without emotional interference, it transforms trading from an emotional roller coaster into a structured process of decision-making under uncertainty. Let's dig deeper into what it really means for a stop loss to be a psychological boundary. Imagine two traders taking the same trade with the same stop. One has accepted the risk fully. Before entering, they've already told themselves, if I lose this trade, it's fine. It's just one of many. The other trader, however, enters with hidden expectations. They think, this one has to work. I can't afford another loss. Both have the same stop on paper, but only one of them has a stop in their mind. When the market starts moving against them, the first trader watches calmly. The second one starts sweating, adjusting the stop, moving it a few points lower, praying for a reversal. One is following a plan, the other is reacting to emotion. Same trade, same stop, completely different psychological experience. The placement of a stop, therefore, is not just about technical levels. It's about emotional thresholds. If your stop is too tight for your emotional tolerance, you'll get shaken out too often and start to resent your system. If it's too wide, you'll experience losses too big for your comfort, leading to hesitation and overcorrection. Later, the correct stop is one that aligns both technically and psychologically. It must fit your belief system, your emotional resilience, and your financial parameters. In other words, your stop loss is as personal as your fingerprint. Many traders seek perfect stop placement techniques, under candle lows, above structure highs, behind moving averages, but those are just technical guidelines. What truly determines success is whether you can emotionally respect the stop once it's placed. Can you take the hit and move on without revenge trading? Can you look at a stopped-out trade and still feel calm, still believe in your process, still execute the next signal without hesitation? If you can, then your stop is correct. Not because of where it's placed, but because of how you relate to it mentally. The irony of trading is that your financial risk is easy to calculate, but your emotional risk is invisible until it's tested. The stop loss acts as a bridge between those two worlds. It gives structure to your uncertainty, and it gives your emotions a framework within which to operate. It tells your brain this is where the experiment ends. Beyond this point, we stop believing in this idea that clarity prevents the destructive spiral of hope and denial that ruins most traders. It's not about predicting when you'll be wrong. It's about knowing when to stop acting wrong. Some traders fear stop losses because they associate them with failure. They hate being stopped out. But that's a misunderstanding. The stop is not the problem. Your attachment to being right is. If you redefine what a stop loss means, you'll see it not as a failure, but as feedback. It's the market's way of saying your assumption didn't align with reality. That information is valuable. It's data you can use to refine your edge. Every time you honor your stop, you reinforce your discipline. Every time you violate it, you weaken your trust in yourself. The psychological damage of ignoring a stop is far greater than the financial loss. When you override your rules, you teach your subconscious that your word doesn't matter. You break the internal trust that allows you to execute with confidence. Then the next time you face risk, hesitation creeps in. You hesitate to enter, hesitate to exit, hesitate to act. You begin second-guessing everything. That hesitation becomes your downfall. One broken rule leads to a cascade of emotional decisions. That's why the stop loss isn't just a tool, it's a contract with yourself. It's proof that you are disciplined enough to keep your word even when it hurts. The greatest traders are not those who avoid losses, they are those who contain them. A stop loss is a containment tool, a way to confine chaos within predetermined boundaries. Without it, trading becomes gambling. With it, trading becomes a profession. It's what allows you to think probabilistically instead of emotionally. It's what allows you to survive long enough for your edge to play out. Because in trading, survival is everything. You can always recover from a small loss. You can't recover from mental collapse. To respect your stop is to respect reality. It's to accept that the market owes you nothing, that it can and will do anything at any time. That acceptance is power. It frees you from the toxic need to be right and replaces it with the calm desire to trade correctly. You start to care less about outcomes and more about process. You stop asking, did I win? And start asking, did I follow my plan? That shift in focus is the difference between a trader who burns out and one who thrives. So when you think of a stop loss, don't think of it as a price level where your trade ends. Think of it as the psychological line where your emotional freedom begins. Every time you honor your stop, you reinforce your identity as a disciplined trader. You strengthen your belief in your process. You send a message to your subconscious that you are in control, not of the market, but of yourself. And that is the only control that truly matters, because at the end of the day, the market doesn't destroy traders, their own emotions do, and the stop loss used properly is the single most powerful tool to keep those emotions in check. It's the invisible barrier that separates chaos from clarity, ego from discipline, hope from acceptance. Respect it, and it will protect not just your account, but your peace of mind. Ignore it, and no amount of skill or analysis will save you. A stop loss, then, is far more than a mechanism to close a trade. It's a declaration of self-awareness. It says, I understand that I am human, that I have limits, and that I choose discipline over denial. When you reach that level of understanding, the market no longer intimidates you. It becomes a mirror reflecting your internal state. And the more you master your mind, the more natural it becomes to trade with precision, patience, and peace. The stop loss is a psychological boundary, not just a price level. It's the line between chaos and control, between emotional reactivity and professional composure, the trader who understands. This doesn't just protect their capital, they protect their sanity. And in a world where uncertainty never ends, that protection is priceless. Accepting loss is one of the most misunderstood and emotionally difficult principles in trading, yet it's the foundation upon which all lasting profitability is built. Most traders spend their early years trying to avoid loss, resist it, deny it, or outsmart it. They believe that the path to success lies in perfecting analysis, predicting outcomes, or discovering systems that never fail. But the truth is far more uncomfortable. You can't eliminate loss from trading. You can only learn to accept it, and your ability to do so with composure and neutrality determines how far you'll go in this game. The market is a reflection of uncertainty. Every moment, it expresses an infinite number of possibilities. Possibilities that no one can fully predict or control. You can analyze, plan, and prepare, but you will never know with certainty what will happen next. Every trade you take is a probability, not a promise. Once you accept that, you stop trying to be right all the time and start focusing on executing correctly. That shift in mindset from outcome to process is the essence of long-term profitability. The refusal to accept loss comes from the human ego. Deep down, every trader wants to be right. Every entry is a statement of belief. I think the market will go here. When that belief is proven wrong, it hurts, not just financially, but emotionally. The loss feels personal, like a public admission that you misread the market or failed to anticipate what others saw. That emotional pain triggers the most destructive behavior in trading: moving stops, averaging down, holding losers, or abandoning systems altogether. It's not the loss of money that breaks traders. It's the loss of emotional comfort. When you truly accept loss, you remove its emotional charge. A losing trade no longer feels like a wound to your identity. It becomes a neutral event within a larger sequence of outcomes. You stop defining yourself by what happens on one trade and start defining yourself by how consistently you execute your plan over many. You begin to see loss not as something to avoid, but as information. Each loss reveals something about your system, your discipline, or your psychological limits. Instead of fearing losses, you start to learn from them. This acceptance doesn't mean you like losing. It means you stop resisting the reality that losing is part of winning. You realize that trading is a numbers game, a business of probabilities. Even if you have an edge that wins 60% of the time, that still means 4 out of 10 trades will lose. Those losses are the cost of doing business, the toll you pay for participation. Trying to avoid them would be like a store owner trying to avoid paying rent or inventory costs. It's impossible. Once you understand that, the emotional resistance fades, and trading becomes a flow of probabilities rather than a battle for validation. The irony is that the harder you try to avoid loss, the more you invite it. The trader who can't accept being wrong will hold on to losers longer than they should. They'll move stops, double down, or refuse to exit because the pain of realization is too great. In doing so, they transform what could have been a small, manageable loss into a devastating one. They destroy their capital and confidence in one move. Meanwhile, the trader who accepts loss immediately takes it without hesitation. They close the trade, review what happened, and prepare for the next opportunity. That trader survives. That trader grows. To accept loss is to embrace the truth that your edge is not perfection. It's consistency. Professional traders don't think in terms of winning or losing trades. They think in terms of expected value over time. Each trade is just one instance in an ongoing series where the law of large numbers plays out. If their edge is positive, the more trades they take, the more the probabilities will work in their favor. But that only happens if they stay disciplined enough to execute their system without emotional interference. And that discipline is impossible without full acceptance of loss. Accepting loss also means redefining what it represents. A loss doesn't mean failure, it means feedback. It's data. It's the market's way of communicating whether your assumptions align with reality. When you lose, the market isn't attacking you. It's revealing a mismatch between your perception and the collective truth expressed in price. If you respond with anger or frustration, you shut down your ability to learn. But if you respond with curiosity, asking why the trade didn't work, you grow. The market rewards those who are willing to listen to its lessons without emotional resistance. Think of loss as the tuition you pay for mastery. Every profession demands some form of cost before competence. Pilots crash simulators, surgeons make mistakes in training, engineers build prototypes that fail. Trading is no different. The difference is that in trading, the feedback loop is immediate and financial, which makes it more painful, but also more honest. If you can't handle that honesty, you'll avoid it, deny it, or distort it. But if you embrace it, you'll develop a kind of emotional maturity that few traders ever reach. Most traders try to control outcomes because they can't control themselves. They use analysis as a shield against uncertainty. They believe that if they just know enough, they won't lose. But knowledge doesn't eliminate randomness. It only prepares you to respond better to it. When you accept loss, you no longer need the illusion of control. You don't need the market to behave a certain way for you to feel safe. You stop needing certainty. You become flexible, adaptive, and detached. That detachment is not apathy, it's mastery. It's the state of mind where you can take a loss and feel nothing but clarity. The trader who accepts loss knows that profitability is a byproduct of emotional balance. They don't chase, they don't panic, they don't seek revenge. They simply follow their plan. Because they've already accepted the worst-case scenario before they entered the trade, nothing surprises them. That internal acceptance frees them from the emotional spikes that destroy consistency. Their focus shifts entirely to process, position sizing, execution, review, improvement. That's how consistency is born. Not from avoiding loss, but from neutralizing its power over you. Accepting loss also creates space for patience. When you are not afraid to lose, you stop forcing trades. You stop trying to make the market deliver profit on your timeline. You wait for your setups because you're no longer desperate to win. You know that missing a trade is better than taking an impulsive one. This patience compounds over time, translating into cleaner execution and greater longevity. Most traders burn out not because they lack knowledge, but because they can't emotionally tolerate the natural rhythm of gains and losses. Acceptance doesn't mean resignation. It means readiness. It means you're emotionally prepared for whatever outcome unfolds. You've already accepted that your analysis could be wrong, that randomness could intrude, that loss could occur. So when it does, you remain calm. You act instead of react. You exit the trade. You follow your stop. You reassess. That's what allows professionals to maintain their mental energy day after day, trade after trade. They don't carry emotional baggage from one loss into the next opportunity. Each trade stands alone. Losses, when accepted, also create trust in your system. When you can take a loss without questioning your entire strategy, you prove to yourself that your belief in your edge is stronger than your fear. That confidence builds over time. It becomes self-reinforcing. Every time you take a disciplined loss, you strengthen your internal structure. You develop what could be called psychological capital, the resilience to endure drawdowns without emotional breakdown. Without this psychological capital, no amount of financial capital will keep you in the game. There's a profound truth here. Profitability is not the reward for being right. It's the reward for being resilient. The market doesn't demand that you predict, it demands that you persist. Persistence is only possible through acceptance. If you can't emotionally handle losing, you'll never stay in the game long enough for your edge to work. But if you can lose gracefully, repeatedly, without emotional damage, you will eventually rise above the majority. Because most traders quit not from financial ruin, but from emotional exhaustion. Accepting loss also aligns you with reality. The market is truth in motion. It doesn't care about your opinions or your analysis. It simply reflects the collective behavior of participants. When you fight loss, you're fighting reality. When you accept it, you're flowing with it. That flow state is what every great trader experiences. The ability to act in harmony with what is, not what they want it to be. Acceptance turns resistance into observation. You begin to see the market clearly, without distortion from your desires or fears. And here lies the paradox. Once you fully accept loss, you start losing less. Not because the market becomes easier, but because your decisions become cleaner. You stop holding on to losers, you stop chasing, you stop overtrading, you allow your strategy to express itself freely, uncorrupted by emotional interference. The losses that remain are small, controlled, intentional. They become part of the rhythm of trading. Inhale, exhale, win, lose. It's all part of the same process. In the end, the acceptance of loss is not just about trading, it's about self-awareness. It's the recognition that your emotions, not the market, determine your results. It's about humility before uncertainty, discipline before impulse, and learning before ego. Every great trader has gone through the fire of loss, and only those who accepted it emerged refined, focused, and calm. So when you sit before your screen, remember, You are not here to avoid loss. You are here to manage it, understand it, and accept it as an inseparable part of the journey. Every loss you accept gracefully brings you one step closer to consistency. Every loss you fight emotionally pulls you deeper into chaos. Accepting loss is the foundation of long-term profitability because it gives you what no indicator or algorithm can: emotional freedom. It liberates you from fear, from perfectionism, from the toxic need to be right. It allows you to trade with clarity, to think probabilistically, to stay grounded in process. When loss no longer threatens your identity, it becomes just another variable in the equation of success. And that's when trading becomes what it was always meant to be. Not a battle against the market, but a dialogue with uncertainty. The more peacefully you can engage in that dialogue, the more profitable you become. Because in the end, the market doesn't reward those who avoid loss. It rewards those who respect it, learn from it, and move through it with discipline and grace. A proper stop is not a defensive measure, it's a declaration of confidence. It's the trader's way of saying, I trust my process more than I trust my emotions. That simple decision, to define where a trade is invalidated and to stick to it, marks the psychological divide between an amateur and a professional. Because a proper stop doesn't reflect fear, it reflects belief. It says, I know that being wrong is part of being consistent, and I don't need to avoid that reality. I just need to manage it. Most traders place stops out of fear. They are afraid of losing money, afraid of being wrong, afraid of the discomfort that comes with seeing a red number on the screen. Their stop becomes a safety net for their ego rather than a tool for executing their edge. But that's not what a stop is meant for. A proper stop is not about preventing pain, it's about preserving integrity. It's the line that separates rational decision-making from emotional reaction. When your stop is based on fear, you place it where it feels safe, not where it makes sense. You place it too tight, trying to avoid discomfort, and you end up getting shaken out of valid trades. Or you place it too wide, giving the market room to breathe, but what you're really doing is giving your emotions more room to rationalize poor decisions. Either way, you are not trading your plan. You are trading your feelings. And feelings are inconsistent. The market exposes that inconsistency faster than anything else in life. A proper stop, on the other hand, is rooted in logic and belief. It's not about avoiding a loss. It's about defining where your trade thesis no longer holds. You're saying, if price reaches this point, the conditions that supported my idea are no longer valid. That's it. There's no emotion in that statement, no attachment, no drama. It's a decision made in advance when your mind is clear and your reasoning is objective. Once the trade is on, your job is simply to honor that boundary no matter what happens. That act of honoring your stop is the ultimate expression of self-trust. It shows that you trust your process enough to follow it even when it goes against your impulses. Because when the market starts moving against you, your brain will scream for survival. It will invent reasons to move the stop, to hold on a little longer, to give it one more chance. But those thoughts have nothing to do with logic. They are driven by the ego's fear of being wrong. If you give in to them, you reinforce a dangerous habit, that your feelings have authority over your rules. Once that happens, consistency is gone. Belief in the process means understanding that losses are built into your system. They are not failures. They are part of the probability curve that defines your edge. Every professional trader knows this. They don't expect every trade to work. They expect the process to work over a large enough sample. That's why their stops are never personal. When a stop is hit, they don't take it as a reflection of their worth. They take it as confirmation that the market has invalidated one specific hypothesis, nothing more, nothing less. Fear-driven traders can't see that distinction. To them, every losing trade is a personal rejection. They interpret it as the market saying, you're wrong. So they fight back, they remove stops average down, or avoid placing them altogether. In doing so, they create chaos, both financially and mentally. They start trading not to follow their edge, but to repair their ego. They stop measuring success by how well they execute and start measuring it by how often they're right. That mindset is poison to consistency. The irony is that the traders who fear being wrong the most are the ones who lose the most, because in trying to avoid loss, they invite destruction. They think that by refusing to exit, they are displaying conviction, but conviction without structure is recklessness. A proper stop is what gives conviction meaning. It defines the boundary where conviction turns into delusion. Without it, belief becomes blind and discipline disappears. Placing a proper stop requires a subtle balance between logic and trust. Logic defines where the trade setup is invalidated. Trust ensures that you'll respect that level when it's tested. Most traders can define logical stops easily, at structural points, below swing lows, beyond resistance levels, but very few can hold that belief when real money is on the line. Because when fear enters the equation, logic fades. Only belief in the process can keep you anchored in that moment. Belief in the process comes from experience. It comes from seeing again and again that the market's randomness can't be controlled, but your response can. Every time you take a loss according to plan, you reinforce that belief. You prove to yourself that you can survive being wrong without emotional collapse. That's how confidence is built, not from winning streaks, but from controlled losses handled correctly. The trader who can accept being wrong gracefully gains an unshakable advantage, emotional neutrality. The stop loss then becomes not a defensive tool, but a creative one. It gives structure to your freedom. It allows you to take risks without fear because you know the damage is limited. It transforms uncertainty from a threat into an opportunity. You are no longer paralyzed by what might happen. You already know what will happen if the trade fails. The clarity frees your mind to focus on execution, not protection. You stop reacting and you start responding. A proper stop reflects belief because it represents faith in probability. When you believe in your edge, you don't need to interfere with it. You let it play out. You understand that over a series of trades, the distribution of wins and losses will align with your expected outcome. You don't try to force the market to validate you on every trade. You don't move stops, chase price, or hope for reversals. You act like a casino, playing the long game, detached from any single hand. That's what belief looks like in practice. To trade this way requires deep psychological maturity. You must accept that the market will do whatever it wants, whenever it wants. You must accept that you will be wrong, often. You must accept that your edge is not about prediction, it's about probability. Once that acceptance becomes internalized, placing stops becomes effortless. You stop seeing them as obstacles and start seeing them as part of the rhythm of trading. Inhale, exhale, entry, exit. Each action has purpose. Each loss is absorbed without resistance. Fear, however, is seductive. It whispers that maybe this time is different, that maybe you should move your stop just a little, that maybe the market will turn. But every time you give in to that voice, you weaken your process. You train your subconscious to believe that rules are optional. Over time, that lack of structure infects your entire trading psychology. You become inconsistent, not just in execution, but in belief. You no longer know where your system ends and your emotions begin. That confusion is deadly. A proper stop creates the opposite effect. It reinforces clarity. It defines exactly what you control and what you don't. You control your entry, your risk, your stop, and your size. You don't control the market. Once you truly accept that, you stop fighting reality, you start flowing with it. The stop becomes your boundary between logic and chaos. When price hits that line, it's not a punishment, it's a reset. It allows you to return to neutral, to start fresh, to look at the next opportunity with clear vision. Many traders think that belief in the process means never doubting. That's not true. Even the best traders experience doubt. The difference is that they act according to belief, not emotion. They might feel fear, but they follow their plan. That distinction is everything. Discipline is not the absence of emotion. It's the decision to act correctly despite emotion. A proper stop gives you the structure to do that. It's the physical manifestation of psychological control. Belief in the process also means accepting randomness with grace. You can place a perfect trade with a perfect setup and still lose. You can make a mistake and still win. The outcome of any single trade is irrelevant. What matters is that your process gives you an edge over many trades. When you place your stop and honor it, you are expressing trust in that edge. You are saying, I don't need this trade to win for me to succeed. That mindset is what separates consistent profitability from emotional chaos. A stop placed from fear says, I hope I don't lose. A stop placed from belief says, if I lose, it's fine. That difference changes everything. The first trader is emotionally dependent on the market's validation. The second is emotionally independent. The first trades to avoid pain. The second trades to express discipline. One is reactive, the other responsive. One is attached, the other free. When you reach the point where being stopped out doesn't trigger frustration, you've crossed an invisible threshold. You've transitioned from trading outcomes to trading probabilities. You've stopped seeking comfort and control and found comfort in structure. You've learned that success in trading is not about being right. It's about staying consistent through uncertainty. That consistency comes only from belief strong enough to override fear. A proper stop is, therefore, a psychological signature. It tells the market, I'm not here to win every trade, I'm here to follow my edge. It reflects maturity, humility, and discipline. It acknowledges that every loss taken according to plan is a victory for your long-term self. Each time your stop is hit, you pay the small price required to remain in the game. You protect your capital, but more importantly, you protect your mental clarity. When you stop fearing loss, you stop distorting the market with your emotions. You start seeing it as it is, neutral, indifferent, balanced between endless possibilities. You realize that you don't need to be right. You just need to manage being wrong correctly. That realization is the foundation of mastery. So the next time you set your stop, ask yourself, am I placing this out of fear or out of belief? If it's fear, you'll feel tension. You'll want the market to prove you right. You'll hesitate to execute. But if it's belief, you'll feel calm. You'll know that no matter what happens, you've already won because you've acted in alignment with your process. And that's what trading mastery truly is. Not predicting the future, not avoiding loss, but believing in your process so deeply that you can let go of control. The stop is your anchor in that sea of uncertainty. It's the silent proof that your discipline is stronger than your fear and your belief in process is greater than your need to be right. A proper stop, placed with conviction and honored with consistency, is the clearest expression of trust a trader can show to their system, to the market, and to themselves. It's not a symbol of weakness, it's a symbol of wisdom, because only those who truly believe in their process can accept being wrong without losing their balance. And that balance, not prediction, is what creates enduring profitability in the long run. The correct stop loss is never about being right, it's about staying aligned with your edge. Every trade tests your relationship with uncertainty, and every stop tests your faith in the process. When you honor your stop, you affirm that consistency matters more than pride, and discipline outweighs prediction. You stop chasing perfection and start building endurance. Trading success isn't built on flawless analysis. It's built on emotional integrity. The trader who respects the stop respects the game. In the end, your stop loss doesn't just protect your capital. It protects your ability to think, adapt, and remain free in a chaotic market.